Hello everybody, my name is Baljan. I am the lecturer at the ITU University and my course is financial risk management and my course is based on the books which consider financial risks, and the first one is a Financial Risk Manager Handbook by Philippe Jorion. Is a 5th edition, and I made the choice between the chapters of this book. Chapters are really closely connected with this theme and opens and describes all the financial situation and risks. So let's start. First of all, the financial risk include types of financial risks. It's market risk, credit risk, and operational risk. Market risk is a risk of losses due to movements in financial market price or volatilities. This usually includes liquidity risk, which is the risk of losses due to the need to liquidate position to meet funding requirements. Liquidity risk, unfortunately, is not amenable to formal quantification. Next one is a credit risk. Is a risk of losses due to the fact that counterparties may be unwilling or unable to fulfill their contractual obligations. And third one, operational risk, is a risk of loss resulting from failed or inadequate internal processes, systems, and people, or from external events. Oftentimes, however, these three categories interact with each other, so that any classification is to some extent arbitrary. For example, credit risk can interact with other types of risk. At the most basic level, it involves the risk of default on the asset, such as a loan or bond. When the asset is traded, however, market risk also reflects credit risk. Take a corporate bond, for example. Some of these price movements may be due to the movements in the risk-free interest rates, which is pure market risk. The remainder will reflect the market-changing perception of the likelihood of defaults. Thus, for traded assets, there is no clear-cut delineation of market and credit risk. Some arbitrary classification must take place. Furthermore, operational risk is often involved as well. Okay, credit risk, settlement risk, market risk, they interact with each other and you should know about it. And also operational risk too can influence in the situation in the financial institution. What about risk management tools? In the past, risks were measured using a variety of ad hoc tools, none of which was satisfactory. These included notional amounts, sensitivity measures, and scenarios. While these measures provide some intuition of risk, they don't measure what matters. This is the potential for downside loss for the total portfolio. They fail to take into account differences in volatilities across markets, correlations across risk factors, as well as the probability of adverse moves in the risk factors. Then, what about a sensitivity measure? Such as duration is more helpful, as we have seen in the bond has 3 times the duration of similar 5-year note. Assume the latter is 4.5 years. This gives a modified duration of D equals 3 multiplied 4.5 and N equals 13.5 years. This duration measure reveals the extreme sensitivity of the bond to interest rates, but doesn't answer the question of whether such a disastrous movement in interest rates is likely. It also ignores the non-linearity between the note price and yields. Okay, next is scenario analysis provides some improvement as it allows the investors to investigate non-linear extreme effects in price. But again, the method doesn't associate the loss with the probability. Another general problem is that this sensitivity or scenario measures don't allow the investor to aggregate risk across different markets. Let us say that this investor also holds a position in a bond denominated in another currency, the euro. Do the risks add up or diversify each other? The great beauty of VaR is that it provides a neat answer to all these questions. One number aggregates the risk across the whole portfolio, taking into account leverage and diversification and providing a risk measure within an associated probability. You should know that VaR is the heart of the measuring in the measuring market risks. Okay, if the worst increase in yield at the 95% level is 1.65%, we can compute VaR as VaR equals market value multiplied modified duration and multiplied worst yield increase. Maybe for example in this case VaR equals 100 multiplied 13.5 and 0.01 and 65 equals $22 million. The investor can now make a statement such as the worst loss at the 95% confidence level is approximately $22 million. With appropriate caveats, this is a huge improvement over traditional risk measurement methods, as it expresses risk in an intuitive fashion. Once that the VaR apparatus is in place, it's easy to implement stress tests, which provide information about extreme losses that is complementary to VaR. VaR is very, very comfortable and convenient to take information about losses and make a forecast of the situation in the worst position. Okay, measures such as notional amounts and exposures have been and are still used to set limits in an attempt to control risk before it occurs, or ex ante. These measures should be supplemented by VaR, which is an ex ante measure of the potential dollar loss. Other risk management tools include stop losses, which are rules enforcing position cuts after losses occur that is exposed. While stop losses are useful, especially in trending markets, they only provide partial protection because they are applied after a loss. Then, value at risk VaR is a summary measure of downside risk expressed in dollars or in the reference currency. A general definition is VaR is a maximum loss over a target horizon such that there is a low perceived probability that the actual loss will be larger. Okay, thank you for your attention. So, goodbye.